Welcome to the Daily Update, where I'll go over the action in the market for Thursday, October 5th, and then we'll see how things are looking for Friday, October 6th. We had a bit of a down day. It was pretty much unchanged when you look at everything together, but the market is really anticipating the employment situation report that's coming out. And so you had people just kind of waiting ahead of that. They don't want to put a lot of capital on the line or make any decisions ahead of that report. And it's going to be interesting to see how this plays out. There's one of three scenarios that can happen. The market likes the report generally because it comes in weaker than expected, and so we go higher. It comes in stronger than expected, so the market really goes lower. And then we have that third option, which means the report's a little bit ambiguous. It's not really helpful for the market to make decisions. And so we end up chopping more or less sideways and not really moving anything and not showing any real conviction. We have to be prepared for all three at the same time. Let's go back and talk about what happened. We did have a lower open. We were down below the daily pivot at 42.51. Prices then fell below S1 at 42.33. As the day went on, we tried a couple of times to get back up to the daily pivot. The second time we were finally successful. We made it up to the unchanged level, but then ended up closing just slightly lower. So we were down 0.13% on below average volume, not really a surprise ahead of the biggest economic report of the month. Our technicals are still negative. We're working off of an oversold condition or extreme negative condition, both in the short and intermediate term. We're also not very far away from the 200-day simple moving average, and we're wondering if at some point is that going to be tested. It's all about the employment situation report in Friday's session, which bleeds through into inflation and interest rates and what the Fed may say and what the Fed may end up doing. Some comments. Interest rates did fall, but it didn't give an awful lot of support to stocks. The mega caps, which were down earlier in the session, they ended up recovering from earlier losses. And those are the stocks that are really giving a lot of support to the market. And if they're doing a little bit better, the overall market is doing better. Oil continues to drop, which could have given some more support to stocks, but it didn't really help them all that much. We're down to 82.29. The micro caps are still below 100 and getting really near that 52-week low spot. Here's our list. It's a little bit shorter. We have the 20-period exponential moving average, the Williams percent R, the stochastics, and our standard deviations chart. Intermediate term, we still have the TTM squeeze, and I have two charts to show you of that. The 50-period exponential moving average study, the PMO studies, the bullish percent index. That's a big one, at least I think it is. It's still down below that 30 level and continuing to drop. And then we're also keeping an eye on the Chaikin money flow. The scenario that we're working with now is the same one that we've been dealing with, that the economy is stronger than expected and that the Fed will keep rates higher for longer and possibly raise rates. We're also keeping an eye on the Chinese economy, and we're also watching oil. The dollar was up and interest rates were down, and we still have the 30 to the 5 and the 10 to the 5 that are back to being normal. The 10 to the 2-year and the 10 to the 3-month are still inverted. Sentiment ticked up a little bit. We were at 19. We're still extreme negative, but now we're at 24. If we get to 25 or above, that's where we jump out of the extreme fear category and we go into more just the fear, where I call it negative or extreme negative. Our trend is still negative overall. We have the ADX above the moving average, both in the short and intermediate term, and both of them are still above 20. And our bias, I'm still keeping it mixed and our momentum at mixed. I think we'll have to see if something plays out in Friday's session or if we end up being mixed after Friday's session. The economic reports that did come out, we had weekly jobless claims, which came in weaker than expected. They had expected 225,000. It came in at 207,000. That's suggesting that the employment situation remains strong. Last time it was at 205,000. The continuing claims ticked down just a little bit, but were not all that much changed. We had 1.664 million. Last time it was 1.665. The trade balance came in at a minus 58.3, lower than the minus 65.1 they had expected, and down from the minus 64.8 billion that we saw last time. Here is the trade balance, where it's still negative. You can see over on the left-hand side, these are all negative numbers, but it is showing a bit of improvement, which may have some impact on GDP. Here's the weekly jobless claims where they did tick up just a little bit from the previous week, but we're watching the 4-week moving average, the blue line, and that's what we follow the most. Here are the continuing claims. Also, we watch the blue moving average where we continue to decline, suggesting that employment remains strong. Here's the unemployment rate, which will be updated on Friday's session. Right now, we're at 3.8%. I just wanted to bring that up so you have something to gauge on. A lot of people don't really pay attention to the unemployment rate because there's so much manipulation that goes on in that. And I don't know, 15, 20 years ago, they changed how it was calculated, and it makes for headlines. It's easy for the financial media and the regular media to talk about. And politicians love it when it works in their favor, or just kind of, you can't really trust it when it goes against them. But it still is something that the market pays attention to. Here are the initial jobless claims where they are in red, and even though they ticked up a little bit, we have been declining overall. The blue line are the continuing claims, which are going down, and then we'll get an adjustment on the unemployment rate. We settled at 4.72%. We're well above the 4.02% that this research suggests that once we're above that level, that runs into some issues for companies and their earnings. Here's the intraday chart where we did have a lower open. We went down below the daily pivot. We went down to S1, fell a bit below that before we tried to come back, never got up to the daily pivot, came back down to S1. Then later in the day, which could be taken as more positive, we were able to break through the daily pivot. We got up to the unchanged level, which was now acting as overhead resistance, and we ended up closing slightly below that. We did see where growth is continuing to outperform value. The blue line's above the red line, even though they're on different scales. Growth ended up being positive for the day where value was negative. And this is also rather encouraging. Going back to about the 22nd of September, we have been seeing growth really outperforming value, which at some point may kick into gear and help to take the market higher. On an end of day basis, we ticked up just a little bit, but we've been chopping more or less sideways, even though we're still in a longer term uptrend. Our condition of our trend is that the ADX is above the moving average. The red line's on top, even though it's declining, but we're also seeing the green line decline as well, and seeing where the short-term trend is also confirmed now, where the red line's coming down and the green line is also coming down. The VIX, if we continue to fall, we will probably go along what has happened on an average basis up until about the middle to latter part of October. And then looking at the VIX on the line chart, we ticked down slightly and we're below 20. We also closed near the low because we closed near the high for the session with the bar chart. And the VIX of the VIX is showing not too much change in the volatility of the VIX, but we're still above the moving averages. We did get the latest reading of the American Association of Individual Investors. They continue to be negative because they tend to react to what's already happened, but not an extreme reading. We went back up a little bit with this fear gauge that we follow. The VIX of the VVIX, and then we take a ratio of that, that's continuing to go up, which is longer term negative. The 5-period equity put call ratio continues to go up, and we're in an extreme area. We're waiting to see if this is going to top out at some point and then turn and come back down. It has not done that yet. The longer term equity put call ratio is also going up, and that is longer term negative. The Ulcer Index ticked down just a little bit. And our advanced decline line, looking at price, we're still below the moving average, both for price and for volume. So that, even though it's ticking up a little bit, it's still negative overall. This is a little bit positive and quite a bit negative right now. We're seeing a real decline with our 5-period and 10-period, and we're seeing more new lows being created than new highs. But we're starting to come back up slightly. Now, we're not seeing a breakout of new highs, at least yet, but at least this is showing some improvement. Now, that could all change with a significant down day in Friday's session. The advanced decline ratio, we're negative, even though we're bouncing up a little bit with both the red line and the blue line. This is potentially positive. We're seeing a bit of an improvement with accumulation distribution. This tries to measure what's the smart money doing. Now, we're still negative, but the fact that we're clicking back up could potentially be positive. And we're also seeing some improvement with the Chaikin money flow. This is also a smart money gauge where it's still negative, but it has been showing some pretty consistent improvement. The risk on, risk off ratio, it's really tending to be more negative overall. It was down slightly on Thursday. Looking at the NYSE cumulative advanced decline line, it ticked up, but it's really broken down below shorter term levels. And then looking at the regular NYSE advanced decline line, it also ticked up, but we're still below this advancing moving or trend line. We're well below the longer term trend line. So I'm keeping that chart out for right now. We're possibly coming down and dealing with the 200-day moving average. In yesterday's video, I called this the 50. That was obviously a mistake. On the bottom, we dropped just slightly below average with volume. And so we turned down just a little bit with our volume indicator, but we're still above this midpoint, showing that volume has typically been above average lately. The Williams percent R is showing some improvement, but it's still extreme negative. The stochastics turning up slightly in the short term, but still extreme, declining a bit in the intermediate short term, and flat, but still extreme negative in the long short term. The force index showing a little bit of improvement, crossing slightly above the midpoint, but we're below zero, so we are negative. Here's the short-term rainbow where we continue to be below all of the moving averages, as well as with the intermediate term chart. The Swenlin trading oscillator, this is a little bit more negative. We had been turning back up. Well, after Thursday, we're starting to tick back down based on price and volume, and we're below zero, so this is negative. The go-no-go system remains at a deep purple state, so that is negative. The TTM squeeze continues to come down and give us what potentially could be extreme negative readings. Here's a longer-term look at that chart to give a little bit of context. We haven't been at this low level in 2023 so far. The last time we saw this was right at the end of 2022. The balance of power turned up slightly, but is still below the dashed line, negative, but showing some improvement. Our moving average study, we're still extreme negative with the 20, the 50, and we're flattening out a bit with the 200. Here's a big one. The bullish percent index continues to drop below 30. If we can get some buying coming in and have this cross back above 30, that could be quite positive for the market. The the summation index based on price continues to decline as well as volume. If we see a real downward move, we might be getting to an extreme negative reading based on volume. The NYSE summation index based on price and volume continue to decline. We're switching or remaining at neutral with the Elder Impulse system for the S&P. The ease of movement turning back up a little bit, but is still below zero. That is negative. The Arun is pretty much flattening out now, and you could make a case that we're getting at least close to an extreme negative reading. The red line on top, that's the sellers, and they came down a little bit, but unfortunately also the buyers are coming down, and that's why we're seeing our oscillator unchanged. Looking at the 200-day simple moving average, we didn't really move all that much with this study. We ticked back up slightly with the 50-period moving average study. On a momentum basis, we have our PMO declining as well as declining based on price and volume. We're no longer extreme with the PMOs that are rising, although this is still negative. We're extreme negative with the buy signals, and we're just on the border with the PMOs that are above zero. We could head into an extreme negative reading. The NYSE bullish percent index continues to decline, is below 50 and not giving an extreme reading. We're pretty much flat with the NASDAQ 100 bullish percent index, but this is still negative. The slope continues to decline, suggesting that the momentum is negative, but at other times, sometimes this will mark a bottom, at least in the short term. The MACD also continues to decline, so that's negative, and wondering if we're going to find some extreme negative reading in here and show some improvement. All of our oscillators, short, intermediate, and long-term, continue to be negative. We're now back to dealing with the 200-day exponential moving average, and we came down here. It was providing support. We fell below that, but we're coming back up, and just we're wondering, is this overhead resistance, or are we just kind of camping out at this spot? We're really watching also the 200-day simple moving average. If we get some downward movement and come down to this point, are we going to bounce up off of that? We're going to break through it, or are we going to still take another couple of days before we even come down and try to test this. Looking at our standard deviations chart, we're pretty much on the border between the -2 and -3 standard deviation. After coming down to the -3, which means that we went down pretty far, pretty fast, we're starting to slow down just a little bit based on this chart. But it's negative because we're seeing all the purple lines pointing down and we're below the midpoint. This is one I haven't shown in a little while. We're seeing a bit of an improvement with the Chaikin oscillator. We're coming back to the midpoint and starting to cross above this. The parabolic SAR, though, still shows that we are negative with the dots on top. We're also keeping an eye on our longer-term fib levels. If we start to fall, is some support going to be found at right around the 42.14 level? And I say around that because anytime I adjust these lines, it changes the figures. And I drew these lines myself. I just kind of have to eyeball it. So be a little leery of that. And the daily special K chart, I usually just mention this, and it's been positive since the early part of summer, but now we're coming back down to this red line. That could be significant. We don't see a lot of crossovers with this indicator, so it's kind of putting a line in the sand, so to speak, where are we going to switch more to a negative backdrop, or are we going to be able to turn and remain more positive? And here's the micro caps where they're still under this 100 level and setting a new 52-week low. This is put out by David Keller from stockcharts.com. He thinks that we have a confirmed head and shoulders top where we broke down below these previous levels. I haven't updated this. We're actually closer down to the 200-day simple moving average. The Heikin Ashi is still negative. The Kigi chart, even though it's negative, it's pointing up slightly. So negative with a shorter term positive flare. The Renko chart is still negative, and the 3-line break continues to be negative. Saw a little bit of a tick down with the equal weight. We were also slightly lower with the S&P weighted index. This is potentially what we've been seeing, not potentially, we have been seeing this in 2023, but could potentially be positive. We're seeing the ratio going up, meaning that the big stocks continue to outperform the rest of the market. And we're still above this S1 level with the Dow. We're well below the 200-day and 50-day moving averages, but support continues to hold even though we were down slightly in Thursday's session. The diamonds still remain at neutral. The NASDAQ 100 chopping more or less sideways. If we break down, we'll be watching these previous shorter term lows. If we start to go up, we'll be watching this pivot level. If we really go up, we're going to be keeping an eye on the 50-day moving average. The Qs still remain at neutral, and we're chopping more or less sideways with the NASDAQ too, watching this pivot level if we go up, watching this previous low if we go down. And here's the fib chart for the NASDAQ where we're just chopping above and below the 50% retracement level. Also keeping an eye on the financial sector. If it really starts to fall, will we come down and test this previous level of support? The small caps, which are still maintaining a price or a closing price above S1, so support is holding here right now, but we're decidedly negative. The blue line is really coming down. We're below the 200-day moving average. We stayed down below here for very long. We're going to see a death cross. Also, the Russell 2000, where we're looking at possibly a head and shoulders top. Here's the left shoulder, the head, the right shoulder, and we're also coming back down to previous support, which so far has been holding up. Are we going to be able to bounce up out of that, or are we going to break down below it? We're extreme negative with the RSI, and momentum shows with the MACD that we continue to be negative. We're back to neutral, though, with the Elder Impulse system for the small caps. The mid caps also maintaining price above this S1 level, but we're below the 50 and 200-day moving averages. The Elder Impulse system has gone from negative back to neutral for the Elder Impulse system. The Dow was pretty much unchanged. We were down just slightly with the transports, ticked down just slightly with the utilities. And interest rates did come down where we topped out, at least for the short term anyway, at about 4.8%. And we've been coming down since that time, which is giving some support to stocks. The 10 to the 5 yield curve is still above zero, so that's turning back to being more normal. The same thing is true with the 30 to the 5 year. These aren't necessarily important curves that we watch, yield curves, but I just plot them, and maybe they're giving us some headway that the 10 to the 2 and the 10 to the 3 month may be getting ready to shift back. We're seeing improvements on those charts, but they're still inverted. And we're still about at the midpoint with our trend channel going back to 2009. Here's more of a refined version of that same chart. We're just about on the trend line currently. The S&P to utilities ratio is going up, not so much due to S&P 500 strength, but it's more due to utilities weakness, where other times, if you look at the chart up above, when we're going up, typically the S&P is going up. We've hit kind of a recent period lately where this has been going up, but the S&P hasn't really been following through with that. We're wondering if we're going to eventually switch back to that more of that relationship. And this also has been giving support to the S&P, but we're not really seeing any follow through based on price. The Staples to S&P 500 ratio, when that's going down, you can see other times when that often marked a bottom in the market. But we're just not seeing an awful lot of that right now. We're keeping an eye on the U.S. 10-year yield and subtracting the 10-year German yield. And that's producing this line that's having a strong correlation currently to the US dollar index. As interest rates have been going up and the dollar's been going up, the correlation continues to get fairly strong. Keeping an eye on growth versus value, where the Qs are still outperforming the S&P. Discretionary is still hanging around its moving average when compared to the S&P. Large cap growth is outperforming large cap value. When we look at our growth to value ratios, showing an improvement with the large caps, mid caps, and small caps. So this could be under the surface strength that is starting to build. We're just not seeing it yet confirmed based in price action. This is negative, though, in longer term. The 50-period exponential moving average of the new highs minus the new lows, we continue to be below 50. That's because our black line, which is the actual indicator, it's down below zero, and that's dragging the 50-period moving average, which is the red line, down below zero as well. We're also getting an extreme negative reading with our 10-day average of the highs minus the lows for the S&P. This often can mark a bottom, at least a short to intermediate term bottom in the market. We need to see follow through with price. The dollar was up slightly, and we're back into the 106 range. And we're also getting close to the end of this 50-day cycle. There's nothing magical about this. You can pick any kind of cycles that you want. It seems like, though, for about the last year, the 50-day cycle has been fairly useful. There's other times when this is marked a top, other times when it marked a bottom, other times when the market didn't really pay attention to this. We just want to be aware of this and know that that turn date is kind of coming up not too far from now. I have still not received the data from Tom Bowley in an email that he sends out for the month of October. So what's our outlook for Friday? We're still dealing with earnings season, but in Friday's session, it's about the employment situation report. The UAW strike is still continuing. They still are battling out about the Speaker of the House. Student loan repayments are restarting. Haven't heard much about that. I haven't really looked it up all that much either. But just think of all the billions of dollars, literally, that could have gone into the stock market, could be going into the economy, that now has to be going back to repaying those loans, and that can put a drain on the economy. Our technicals were still negative. We have a confirmed short and intermediate term downtrend, but we're still working off of this oversold condition. We will get the employment situation report in Friday's session, also keeping an eye on the different geopolitical events in case one of those comes flying in and has an impact on the market. Here is the calendar for showing that the employment situation report will be coming out on Friday. Looking at the Stock Traders Almanac statistics, it's pretty negative, at least on a historical basis. The Dow and the S&P, they're only up 38.1% of the time on October 6th, where the NASDAQ's a little bit better, but it's neutral to negative. And then wondering, are we in this bounce time? Are we going to be pulling back down when we look at pre-election years? And then this chart shows where we have a sitting president who's running for re-election. Here's the Carson data, maybe suggesting that we're moving beyond this slight uptick now and going more into some weakness. Or did we ever even see any real uptick in the first place? And is that still yet to come? Then looking at the NASDAQ, where we're wondering, are we ticking up and then flattening out before we see a little bit of weakness going into the end of October? And we're also seeing pretty much that same thing with the S&P. So it may not match day for day what's actually happening because we've been chopping around quite a bit. But at some point, you'd think the market's either going to break to the upside or continue to go to the downside. And we're up 10 out of 18 times for the S&P going back to 1950 during pre-election years. We're down 8 out of 18 times. And then looking at Bitcoin, again, depending on what years you want to choose to look at, nothing's really happening right now. I actually have a chart of this where if you pay attention to what happened from 2018 to 2022, we should see a nice little bounce. But if you go back and look at all the years, pretty much nothing tends to happen. And I'm not a Bitcoin person. I think it's just full of people that really don't know what they're doing overall. You may disagree with that. But we did see a recent death cross here, and we're not really seeing much of a bounce currently in the market. So we're kind of going with that sideways pattern. I do find it to be an interesting market to watch, and that's pretty much all I do. So our scenarios for Friday, we're leaning more towards the down one because that's what our charts suggest to us. We do have a confirmed downtrend, and we're wondering, is that 200-day simple moving average going to be tested? We're not going with the up one or the sideways trend right now because our ADX charts suggest that we are in a trending environment. The warning signs, and I seem to sound like a broken record here, the longer term trend lines that we look at, and I go through those in the weekly chart, we're still well below that level. Seasonally, October tends to be better than September, but it's kind of hard not to improve over September. The equity put call ratio, the 5 period, that's going up, and our longer term equity put call ratio is also going up. That's negative. All of our oscillators continue to be negative. The cumulative new highs, new lows for the NASDAQ are showing weakness. The 3-month yield, okay, we're still above where we were back in 2007. We're waiting to see if that's going to roll over. The 50-period new high, new low study has crossed over negative. That's longer term. And we've been positive for pretty much all of 2023. The fact that we're switching over negative doesn't mean it has to stay that way, but that could also be longer term negative. The Russell is still below its 200-day simple moving average, wondering if we have a head and shoulders top. The parabolic SAR and the vortex indicators continue to be negative, and we're kind of ending one earnings season and starting to come into another earnings season. On the positive side, we still have seasonality and setups, which I go over in the weekly video. Those are in the background. The daily special K chart, we need to watch this one. We might cross over there and turn negative. We're still above the downtrend channel upper line. The risk on posture continues to be showing weakness. The Staples S&P 500 ratio, it had been declining, but now it's showing a little bit of improvement. But we're not really seeing a lot of follow through with that. We want to see some more. And the S&P to utilities ratio is going up, which often gives support to the S&P. Are we going to see any of that? The Russell, the small caps and the mid caps, they do have golden crosses not so long ago, but we're going to lose that if the longer we stay below those 200-day moving averages. Small and mid cap growth continues to be positive. The financial sector also getting hammered lightly below its 200-day moving average, but still working off of a recent golden cross. So our conclusion, we're negative. We have a confirmed downtrend, and we're wondering, is the 200-day simple moving average going to be tested? In the short term, we are negative, but still working off being oversold. Pretty much the same thing for the intermediate term, and we're still positive in the long term because we're above the 200-day simple moving average. Now, that could change at any time, but it hasn't changed yet. So thank you. I hope you have a really good day on Friday. I'll be watching things like everybody else, and I will talk to you in the next video.